following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So it's Friday, and we're going to be talking about money. Now, assume or think about if you received an email from a financial advisor or a phone call from a financial advisor, and the advisor said, I want you to remember, I want you to buy this stock because it's going to be up by the end of the month. He calls you at the beginning of the month. You look at the stock, and sure enough, it's up at the end of the month. And now you get another email. And that same person says, I want you to sell short this stock because it's going to go down at the end of the month. And the second month, sure enough, that stock goes down. Now he calls you or sends you an email the third time and says, I want you to buy this stock because it's going to go up at the end of the month. And sure enough, it's up. And then you get a fourth email or a fourth phone call, and they say, here's another one that's going to go up at the end of the month. And sure enough, it does. And that whole process is repeated up and down 10 times. And every single time, that financial advisor is right. His prediction is at the end of the month, it's going to be up or it's going to be down. And sure enough, it works 100% of the time. Now, at the end of 10 times, that financial advisor says, I've now proven myself to you. I want you to make a very large investment because we're going to make a lot of money. Do you do it? Do you do it? Well, there's more to the story. But that's going to come later in the program. So don't go away. I want to tell you what the rest of the program's about. There's a book that was written back in 2001 called The Myth of Excellence: Why Great Companies Never Try to Be Best at Everything, written by Fred Crawford, Ryan Matthews. They talked about 5 attributes of companies. They talked about price, service, access, experience, and product. Those were the 5 attributes of a company that they felt that every company could be described in. The price was, a lot of businesses brag about being cheap. But the surveys they did, and they surveyed a lot of customers of businesses to find out what customers really liked. And the survey, in that the respondents responded, it wasn't the best price they were looking for. They were looking for an honest and fair price. In terms of service, what customers were looking for were basic, everyday needs. They weren't looking for bells and whistles. They wanted the companies to recognize that everyone is an individual, and they wanted people to recognize and make their products custom for them. That was what service was about. In terms of access, you think about access as the local bank branch at the corner, but it's more than just location. It's the physical and psychological as well as location. Customers didn't want to be confused or slowed down by clever or elaborate spins. They talked. The fourth attribute was experience. And experience is not entertainment. Experience was respect, that people were treated, customers were treated like human beings, that the business focused on their unique needs and unique products to meet those. And you can kind of see some unique things that happen in high tech. Remember the Palm phone. You remember the BlackBerry and the iPhone and that whole progress. That was an experience. Those products were unique. They had special characteristics. And final attribute was the product. But just because a business believes their product is the best doesn't necessarily make it so. For the vast majority of customers, they weren't looking for the very best. They were looking for something that was consistently good. So they defined those 5 attributes of a business: the price, the service, the access, the experience, and the product. Those were the 5 aspects of a business that they talked about. And they defined 3 levels of relationship. A level 1 was where people developed enough trust to buy the products. They trusted the business enough to actually go out and make purchases. That's a transactional kind of relationship. They'll buy from you, but there's nothing special about what they do. The second level is where they actually prefer your store or your business or your company. They like your products and their services, and they like doing business there. These are companies that found a way to differentiate themselves and had a real value proposition. And the third level of relationship was one that the trust was so complete, they sought out that business. Not only did they differentiate, but those businesses dominated. It's interesting because the companies that were mentioned in that 2001 book have changed. Richard Foster of Yale did a study and came up and talked about the businesses that were part of the companies that were part of the S&P 500. The S&P 500 in 1920 had an average life of 67 to 70 years. Today, the average life has shrunk to 15 years for the S&P 500. The book, which was published in June of 2001, talked about some of the companies that met the criteria that they were talking about, the companies of great excellence. They talked about Walmart, America Online, Southwest Airlines, Lexus, Eddie Bauer, Citibank, eBay, Nokia, and Dell. You know what's happened to a number of those companies? They're not dominating their markets. You see that as an ongoing process. It impacts investments and how we invest. It impacts my industry. My industry, when I was licensed as a financial advisor, actually I was licensed, we called ourselves stockbrokers in those days. That goes back a ways. When I was licensed in 86, the national brokerage firms, the ones you know the names to, they dominated the markets. They had 90 to 95% of the market share. Today, those same firms have lost half of their market share, down to 43%. They failed to continue to be great companies. But it wasn't just having those 5 attributes, because what they said, the myth of excellence, was having and trying to dominate in each one of those areas would be a death of a company because it would economically be unviable. So what they said is companies had to pick which ones. They had to dominate in one of the 5. They had to dominate in price, in service, in access, experience, or product. They had to be and differentiate themselves in one of those 5. And they had to be dominant in one. They had to differentiate themselves in another. So price, service, access, experience, and product. They had to dominate in one of those. They had to differentiate in one of those. And they had to be adequate in the other 3. If you tried to be dominant in 2 or 3, the economics would drive the price or would drive you out of business with competition. It's being successful. So I thought it would be interesting to apply. For Adams Financial Concepts, it's clear where we are. But not all financial advisors are the same. I happened to go to a conference in Florida. I went specifically to hear one person talk, and that was Rick Edelman. He had a growth plan. He is, in financial circles, probably the third best recognized person in financial. Jim Cramer of CNBC is number 1, Susie Orman is number 2, and Rick Edelman is number 3. Rick Edelman had a growth plan, and he focused on being successful. He generates 25,000 leads per year. 25,000. He has a radio show. He has TV. He does 800 seminars per year. He cultivates the media, and he writes a book every year. That's how he generates it. He has 113 advisors that were working for him when I went to see him. And he had a very cookie-cutter approach. The office layout was exactly the same in every one of those 113 advisors. The desk faces the window. There's a coffee table. There's a couch on the other side of the coffee table. So when the advisor meets with clients, you turn around so the clients are looking out the window. You have a coffee table in between. Every single office was the same. And never put the Wall Street Journal or any magazines on the table. Always put down Rick Edelman's books. We'll be back and talk about this to see how it applies. I am not there. I think I have a different concept, but we'll come back and talk about the whole thing. And you also want to know about those recommendations for stocks. We'll come back and talk about those, and I also have a guest. You want to hear what he has to say. Be right back.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I've been talking about The Myth of Excellence, a book written by a couple of authors that talk about 5 aspects of a business. And I've been applying it to a conference I went to. I went to hear Rick Edelman. Jim Cramer is the most recognized person, Susie Orman second, and Rick Edelman hasn't quite reached double digits for recognition, but he's number 3 to those, second or third only to those 2. But when I went, he described his process. Obviously, he was trying to recruit financial advisors. I went because I heard that he was going to give this presentation about his business. I wanted to know about his business. It's a very successful business. He generates 25,000 leads per year. I wanted to know how he did that. So I went, and it's a very cookie-cutter approach. The office is always laid out exactly the same. 113 advisors walk into one office. You cannot distinguish it from being any different from any of the others. In fact, he said when they prepare a financial plan, if the advisor is on vacation, another advisor can come in and present exactly the same thing to the customer, the client. It will be exactly the same thing. No differences. And they control it very well. They have a quality control person that makes sure that everything is the same. There's no concern with superior performance. It's always the same financial plan. and they cultivate and service their clients. The impact of that business is that 75% of the clients say that Edelman is the best company they've ever worked with. Among all the companies, not just brokerage firms, they're better than Nordstrom, better than Starbucks, better than almost any other company. That's significant. But of the 5 qualities, if applying this whole thing to the myth of excellence, access dominates. There's nothing confusing. There's nothing elaborate. There's nothing clever. It's very basic. It's very consistent. It's always the same. They differentiate themselves. That's access dominates. Experience is where they differentiate. They respect. It's not an entertainment thing. They respect the people. They're treated well. And it's always treated in the same way. Service is adequate. What they do is consistent, and every plan is geared to the individual investors. You go in with your financial information, and the plan fits your financial information. Always the same. If you go in to one office with that information or to another office, you're going to come out with exactly the same recommendations and numbers. The price is average, and in fact, the price has been going down because it's adequate, nothing special. And the product is adequate. Consistently good financial plans with no focus on being the best. He's been successful. He and his wife started the business in 1986, and today, 113 advisors. Very, very significant. I have some problems with that because I believe that part of what we do at Adams Financial Concepts is products is something where we want to dominate. We want to deliver financial returns that are above the market returns because we believe that building a financial stability and building financial wealth is what we're about. Services where we differentiate ourselves because every portfolio is designed specifically with the client objectives and risk tolerances in mind. Our price is adequate. We don't compete on price. We're honest and fair. Access is adequate. Experience is adequate. We treat everybody as individuals. We respect the individuals. And why is the product our number one choice? Because I think that's illustrated. I've been asked to write articles and answer questions on Investopedia. And I thought I'd read, just for fun, take one that was posed yesterday that I responded to. And the question is, I'm a 54-year-old married man with 2 children in college. I have enough saved in a 529 along with their scholarships to provide full undergraduate educations, and for them, debt-free. Grad school is on them. My wife and I both work with an income north of $200,000 collectively. We have amassed about $950,000 in our 401k plans and another $100,000 in savings. We own our own $350,000 home mortgage-free. We maxed out our 401k plans at $48,000 per year and contribute to our Roth at $200 a month each. I estimate, and this is continuing the question, I estimate that at 65 years old with a minimum returns will have about $1.3 million and our home debt-free. Is that enough? What else should we be doing? That was the question. Now, there were 4 of us that answered the question. 3 answered the question and said, congratulations, you've done really well for yourself, and you should be set. I looked at it and I said, this was my answer. $1.3 million seems like a big chunk of money. However, with only $1.3 million, you run a significant risk of running out of money. As Joe pointed out, Joe was one of the other financial advisors that answer. As Joe pointed out, with a 3% withdrawal rate, you'll earn about $39,000 per year. And if you get maximum Social Security, currently at $2,639 per month, you will have a total income of about $100,000 per year. That's a replacement of about 50% of your current income. You risk running out of money in your mid-80s. The average life expectancy of a 65-year-old when you retire will be in the high 80s if current trends continue. Could be into the 90s if we're in a higher trend. That means that half 65 years old, half the people 65 will live beyond into their 90s, and the fastest growing segment of the population are the centenarians. You will need, in reality, you'll need almost $4 million to maintain your current income without a risk of running out of money based on a 3% withdrawal rate. There are 4 options for you to consider. Number 1, you can save more, but it's unlikely that you'll get to where you need to be solely by saving more in the next 11 years. Number 2, you can work longer and postpone retirement. Number 3, you can seek better returns. And number 4, a combination of the above. I wish I could say that you have all you need, but in all honesty, that would be deceiving you. You're short. If you continue to save as you are now, work 2 extra years to age 67, and achieve 8% per year returns, you should be very close to the $4 million, what you need. That was my answer. Actually, I added, if you plan to hire a financial advisor, I'd recommend doing so, and find one that publishes at least a 10-year track record showing a composite for all accounts with no carve-outs. Carve-outs, for your information, some financial advisors will carve out poor performing accounts, new accounts, and terminated accounts. You want to be sure that all those are included. Also be sure the track record is actual and not a back-tested hypothetical return. And I finished by saying you're asking the right questions at the right time. You have enough time to achieve a successful retirement and enjoy your golden years. I think that's the difference between what I do and what other financial advisors do. $1.3 million seems like a lot of money, but in fact, that would leave those people very high at risk of running out of money. 47% of people nearing retirement today fear that they're going to run out of money before their life ends. I think it's a very real question and a very real answer, and it needs specific response. Anyway, I want to wrap that up, and I want to introduce my guest today. So my guest is Howard Chodar of taxman.cc. Welcome to the program, Howard.
Thank you, Michael.
So why don't we start with your background?
Okay. I moved here from Pittsburgh, PA in 1983 when Seattle was a nice, livable, fun city, small town. And when I got here, I started working for the IRS, which was a noble move, but I ended up staying there for 15 years, 15 long years, and had risen to the top of the GS scale. And my next move was, they kept saying, do you want to go into management? Do you want to go into management? And I looked around at the people in the room and I said, who would want to manage these people? And I came to a conclusion, I shouldn't have been here in the first place. And after 15 years, it was probably time to move on. And so I left, which is unheard of in a government job with a pension. But I thought life's short and had a midlife crisis. I was 37. It was time to move on. So I left and hung out my shingle on my own. And after a couple of months, I looked at my phone didn't ring. Looked at my phone didn't ring. And I talked to another tax attorney who was a friend of mine who had left the IRS earlier. And he said, you're going to have to wait 3 years. He said, then you're going to look at that phone and say, I wish you'd quit ringing so that I can get some work done. And he was right. Sure enough, in 3 years, that phone started ringing, and now it's going on 19 years, and the phone rings and rings and rings, and I have staff, and
we're going to come back and find out why that phone rings and what questions people have. So don't go away. We're coming to commercial break. We'll be back right after this break.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Answer. About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I'm here with Howard Schroeder of
taxman.cc. Yeah.
So we started talking. He came out of the IRS and started his own firm. Now the phone rings. So why does the phone ring, and what kind of calls are you receiving?
Well, I'm in a unique situation in that I'm able to offer insider IRS type of information. I mean, I worked there 15 years. I understand the procedures. I understand the staffing. I understand the kind of the internal mechanisms of how the IRS works. What tax returns get audited, for instance.
So which tax returns do get audited?
Oh, that's a great question. Well, every tax return gets a score assigned to it. Yours, mine, Bill Gates, Paul Allen's. We all get a score. And what the IRS is looking for is anomalies from comparing deductions to income, or high income that would be on a Schedule C, like as a self-employed business person, that would get a higher score than someone who gets a W-2 and is a wage earner.
Mm-hmm.
So this score that's assigned, it's called the DIF score, and it's Discriminant Income Function Score. It's an acronym like IRS, everything the IRS is. And that score is based on your income as opposed to your deductions, as opposed to where you live and your occupation. And they put that into a statistical analysis. And then that statistical analysis pops out a score, and they won't publish the score. The score is not for public consumption, but everyone kind of knows after you've worked there long enough, or after you've seen tax returns get audited, well, what triggers this score to go higher? It's kind of like the Coke formula. They'll never let you what the Coke formula is, but there's sugar and carbonated water and citrus, and so it's kind of the same thing that after a while you say, well, that tax return's going to get audited, or that tax return probably won't get audited. No guarantees in life, but and you know what? I'm pretty accurate at looking at tax returns. And so one of the reasons that people come to me is that they say, well, my tax return get audited. And I can, with some surety, I can't guarantee it, but with some assurance, I can say, you have a high chance or a low chance. And if you have a high chance, maybe there are some options available.
So when somebody does get that notice in the mail that says you're going to be audited, what's the proper thing for them to do?
After they cry or before? It's funny about notices, because in my lifetime, I see 40, 50 notices a day, over 35 years. And people really, when you see your name attached to a letter that's from the IRS, it's traumatic. And so I always try and calm my clients down and calm people down. But one time I got a letter from the IRS with my name attached to it and said I owed this huge penalty, when in fact I knew I didn't. But for the life of me that night, I could not sleep. And then it hit me, wow, I really know what these people go through.
Yeah.
And so if you do get a letter from the IRS, the first thing you would want to do is to contact a professional. And not just any accountant, because there are lots of accountants out there, but an accountant who has experience in dealing with the IRS. It's kind of like going to court by yourself. You wouldn't go to court by yourself, and you shouldn't be represented. You should be represented by someone when you go against the IRS.
But it's more than just someone that claims to have experience dealing with the IRS. I've been through an audit, and I went through having somebody that claimed to have had experience. And I think that I significantly overpaid. There was a lot of work done that I paid for that never came up in the audit. A lot of that was done before the CPA ever met with the IRS person. So your thoughts on that?
Well, sorry to hear it. It's kind of an art. It's an art form to how to handle an audit and how to get a good outcome. And you're right. There are, in any profession, I'm sure in financial advising, anyone can say they're a financial advisor and get a license. And so I think it comes down to referrals. I think it comes down to your friends or from someone who's been through an audit. Just no different than someone the other day was asking for a hip doctor and who they went to see to have their surgery. And so I think it's just, and that's why the phone is ringing, because I represent a lot of people, and because with satisfactory results, and they say, you have an IRS issue, go see Howard.
So when they come to see you, if I come to see you, if I'm not being audited right now, if I came to see you, what would be the steps that you take?
Well, that's a great question. So the steps would be that to contact the auditor on behalf of you or the person getting audited, find out what the IRS needs, and provide that information. There's no sense in trying to hide information from them at this point, but rather to provide it. And but then it's also how you interact with the auditor, as well as areas that would be close, reasonable. You know, where's an area that both parties, the taxpayer and the IRS, can live with, and that's where the art comes in. And knowing that the IRS wants to settle cases, they don't want to go to appeals, they don't want to go to tax court, and that of course costs the client money, and weighing all those factors together and coming up with a solution that everyone wins a little and everyone loses a little.
So there's one other area that has become a very hot thing with the IRS, and that is identity theft.
Mm-hmm.
And not specifically by somebody stealing, but by people filing a tax return. So what has happened there?
So I guess there must be syndicates out there that buy Social Security numbers and groups of them, and what they do is they turn around and they file a fictitious tax return under someone's Social Security number. And the IRS did not react very well to this in the early stages, and I think through the years Congress has gotten pretty upset with the IRS, and they've cut their budget and said that you really need to, this has to be a priority for you. What happens is someone will file a tax return with a W-2 attached, get a small refund. They won't make it large because a large refund would flag it or stop it, and so it's smaller refund, and they issue them $2,000, $2,500, $3,000. And then what happens is the real taxpayer turns around and files a tax return, but their Social Security number is frozen because there's already been a tax return filed under that Social Security number. Now it's a problem for the real taxpayer. They have to send in a paper return, they have to attach a copy of their passport. If they have a refund coming, those refunds can delay for months and months and months. And I've had clients that call them and they say, we have everything. We just don't have the staff to go through this. The IRS staff, due to budget slashes, has gone from 110,000 when I used to work there, and it's down to 80,000 at this point, with more tax returns coming in than ever.
So it really does get delayed.
Oh, horribly.
And so somebody that experiences that, would they call you?
Probably a great start. The IRS is very difficult to navigate these days. Wait times on calls are sometimes up to 2 hours. Sometimes you'll get through, and then the person on the other end will say, "Oh, sorry I picked up. I didn't mean to, but it's my lunch break." And they'll hang up. And the poor person has to call back and wait in queue again. Horrible circumstances.
So how would somebody get a hold of you if they wanted to, if they've got a tax audit, if they've got a tax problem, if they just want to have you prepare their taxes with your expertise?
Sure. And I'd love to entertain that idea. So the best way is through my website at taxman.cc. And through there, they can email me, howard@taxman.cc, or to call me. I'm in Seattle, right at the edge of Capitol Hill and downtown, in a very convenient location, easy parking. 206-323-1066, 1066.
So would you give the information again, just in case somebody
Sure.
missed?
The website is taxman.cc, taxman.cc. My email address is howard@taxman.cc. And lastly, the phone number is 206-323-1066. 1066, for all you history buffs, is the Normandy invasion.
It is.
Yeah,
William the
there you
Conqueror. Thanks, Howard.
Great to be here.
Fantastic to be here. And in the next couple of weeks, you'll also see the information on our resource page, adamsfinancialconcepts.com. You'll be able to find that information there. So if you happen to miss all this and do have a problem in 2 months, you have somebody to contact. I recommend it highly. We're coming to a commercial break. We'll come back and talk about the guy that sent emails and correctly predicted the direction of 10 stocks. Don't go away. We'll be back after the break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I asked a question at the beginning of the program, or talked about a scenario that you are at home or your business, or you receive an email from somebody that says, look at this stock, in a month it's going to be up. And sure enough, a month goes by and the stock is up. And then you get another email saying, look at this stock, it's going to be down after a month. And sure enough, you look at it after a month and the stock is down. And then you get another email at the end of that month, say, look at this stock, it's going to be up. And sure enough, at the end of that time, that stock is up. And then you get a fourth letter, that says, look at this stock, it's going to be up. And sure enough, It happens 4 times the person has been right. And it happens a 5th time and a 6th time and a 7th time, and 8th time, 9th time, and 10th time. And then you get the call from that financial advisor that says, I would like you to make a big investment because I've been right 10 out of 10 times. Would you do it? Well, the rest of the story, and there is a lot more story, is that person started out and sent emails to 10,240 people. To 1,120 or 5,120, he said the stock was going to go up. And to 5,120, he said the stock was going to go down. Now, the people that got the one that said it was going to go down never heard from him again, or her. The people where he predicted correctly, he divided those into 2 groups. And the second month, he sent out 2,560 letters saying the stock was going to go down, 2,560 and said the stock was going to go up. And sure enough, for those that he heard from him, half of those 2,560 where the stock went down were to hear from him again. This time, he divided it once again. So 1,260 heard that the stock was going to go up, and 1,260 heard that it was going to go down. And those who got the email where it didn't work out never heard from the person again. But he continued that, or she continued that same way until eventually you get down to 10 people. 10 people were all that got the correct email, but time by time. And then they get the big request to invest. And those 10 people think that person has correctly predicted 10 times. It's a classic problem. It's a classic story. It's called the Baltimore Stockbroker. Nobody knows if there was really a Baltimore stockbroker. Nobody knows why it was called the Baltimore Stockbroker. Nobody knows why it was Baltimore and it couldn't have been Atlanta or Seattle. But it's a classic problem that there's a whole lot more to the story than you ever realize. And we live in an industry in financial services where there's a lot of things, where there's a lot more to the story than you never hear. I can remember when I first got into the business, and I was working for Payne Weber at the time. I was a brand new financial advisor, stockbroker. And when brokers left and went to a different firm, their book of clients were passed around, and you called people to get them to stay with Payne Weber, or if you were at Morgan Stanley, or if you were at Smith Barney or Merrill, whoever it might be, you call those people to try to get them to stay rather than moving their account. And I inherited this one account of a person, and because I was brand new, I was a small broker, I didn't produce very much at that time, and I received an account for one person that had made one single investment of $10,000 in a mutual fund. And at that time, a couple years later, after she had made that investment, 2 years, 4 years, I don't remember exactly how long, but the account was now down to a little over $8,000. So it had been a 20% loss. Now there's distributors, mutual fund distributors that come into the office, and they're pumping their products, and they're pumping what they do. And they came into the office, and the presentation was on that particular mutual fund. That very same mutual fund. That fund which had shown over a period of time a 20% loss. And he put up a chart showing this is a mutual fund that's made 20% per year. 20% per year. And I looked at that, and then I went back to my cubicle, because I didn't deserve an office yet. I went back to my little cubicle, and that client had put in $10,000 and had gone down to $8,000. So I took my book, and I said, how could that be? And the wholesaler didn't really have an answer. It took me a while to figure out how that could be. And the reason is that mutual funds get merged into other mutual funds. And the mutual fund in which that woman had invested had been merged into another fund. The fund she was in was a bigger fund, a much larger fund, and you'd expect the bigger one to survive the smaller one. But the small one had a really good track record. So they merged the big one into the small one, and they claimed the track record for the small one. So instead of showing a loss of 20%, it showed a 20% per year gain for that period of time. That's not uncommon. That happens. Very often, firms will launch a mutual fund for a year or two to build a track record. And if the track record's no good, you never hear about that mutual fund. It all goes away. You know, there's a whole lot of things that go on. There's a talk about the expense ratio of funds. If fees and expense ratios are higher than a fund, the returns are usually lower. All things being equal, that's true. There are, however, funds that outperform. Eugene Fama shared the Nobel Prize in 2013 by showing that in one paper, 3%, and another paper, 7% of fund managers earn their fees. They perform as well as the market when you consider the fees that they're charging. A very small number, whether it's 3 or 7, that means that it's 93 or 97% never do as well as the market did. But what doesn't go into the disclosures is that the expense ratio isn't all that people are experiencing in a mutual fund. There's a trading cost. There's a cash drag because mutual funds have to keep a certain amount of cash for redemptions. And there's a tax. Edelin, Evans, and Kedlick did a paper in which they talked about the impact of those expenses which you never see, never hear about. They are as large as 3 to 4% per year. That's a significant drag on the performance of that fund. People talk about a low expense ratio being less than 1%, but they never talk about the other 2 to 3% or 4% of drag. That's like the person that receives those letters saying, I've been right 10 times. Now's the time to invest. You know, the idea of this program is to give you, the investor, insight into what's going on so that you can be ahead of the curve, so that you can understand what happens in my industry, that you can understand what happens in other industries, so that you can be best prepared to achieve your financial goals. That's what it's all about. And I hope that that works. That wraps it up for today. Have a very great weekend and a very good week coming up. Stay cool. It's going to be warm. And I will be back next Friday.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Your business leader for Seattle is 1300 KKOL.